So we have all sorts of questions about these kinds of taxes, the personal and corporate income tax in particular. First question is, what constitutes income? If I give you $100, you're supposed to put that, right, on your income tax or no? Well, the answer is no. If I give you $100 as a Christmas present, you don't have to report that. That's not income. If I give you $40,000, now you have to report that. All of a sudden, that becomes income. If you are in a car accident and you sue somebody and you get some money, you don't have to pay taxes on that. It's not income. So there are things that are income and things that are not. We have those things that aren't, like your federal income tax. You don't have to pay a tax on income from state bonds. That's an exclusion. It just doesn't count. Small gifts don't count. Exemptions are things that are put in there by law to be exempt from taxation. And if you're saying, what's the difference between an exclusion and an exemption? We kind of just wing it. And again, in your tax return, there's a big difference, but it's just things we put into different categories. So some things are exempt, some things are excluded. Then we have deductions. The difference between a deduction and an exemption and an exclusion, if something is exempt or excluded, it goes off at the top. So you might have had $100,000 in income, but $10,000 of that is exempt from tax because it's from a state bond. So off that goes, and you don't put that in, and you get $90,000 in income. A deduction is subtracted after the fact. So now we figured out what our income is. Now we deduct things like the interest that we pay on our home. If we have a mortgage, we can deduct our home mortgage interest. That comes off after our income. So some things we exclude, they don't count as part of our income. So then we write our income down. Then we write down our deductions, and we take our deductions out of our income. Okay? Usually, again, the way we talk about this, we take the exclusions off, and then the exemptions come at the end, but don't worry about that. We subtract deductions off. What that means is, if I have $10,000 in a deduction, it doesn't lower my taxes by $10,000. It lowers my taxes by a percentage of the $10,000. So we have these things called tax brackets. What we have are what we call marginal tax rates. And what that means is that maybe for the first $20,000 in income that you make, you have to pay 5% in tax. And from 20,000 to 50,000, the next 30,000, you have to pay 20% in tax. And from 50,000 to 300,000, you have to pay 25% in tax. And from 300,000 to $1 million, you have to pay 30% in tax. And above $1 million, you have to pay 39. If you pay 39 above $1 million, that doesn't mean you pay 39 on your whole income. It means you paid 5% on your first 20,000 and 20% on your next, and you paid lower percentages on that first part, and it's only the part over $1 million that you pay the 39 in. So that's a marginal tax rate. Okay, so we have these tax brackets. Originally, the plan was we had 7. We went down to 6. The plan was to go down to 2. Lots of people think we should go down to 1, but 2. But we only went down from 7 to 6. So a millionaire, again, might pay one rate up to the first 25,000, a different rate on the next 25, and so on. Okay, the highest rates were in the 90% during World War I and the Korean War. So we're paying for these wars in part by putting really heavy taxes on rich people. Then we lowered them down to 70%, and again, you'll hear AOC talk about wanting to get that marginal rate back up to 70%, and we might talk about that at some point. They were at 70%, and the Reagan tax cuts took it down to 28. H.W. Bush and Clinton both raised those tax rates back up into the 30s. W. Bush lowered them down a little bit again. Trump lowered them down again. But either way, they haven't been anywhere near that 70 in a long time. And again, the original income tax only applied to very wealthy people. So when that original income tax was put in the World War I period, it was inflation adjusted. Only people who made, somewhere between $500,000 and $1 million a year and up paid income tax. The vast majority of Americans didn't have any income tax liability. So you can see on the graph, the red line is the maximum tax rate, the blue line is the minimum tax rate, and you can see that the minimum tax rate has stayed a lot more the same, but little variation there than the maximum income tax rate. And again, it's been over 90% and down into the 30s in the last 40 years. So the top 1% of all taxpayers pay 17% of federal taxes. The top 20% pay 70%. The top 40% pay 86%. Top 60% pay 95% of all the taxes. You may remember, again, there was a video of Mitt Romney talking about the 47% that he didn't care about. That's the 47% of U.S. households that did not pay any income tax that year. So we're not talking about, got a tax that they just didn't owe any income tax. Almost half of U.S. households in 2012, largely because of the recession, did not owe any income tax. So the rich pay most of the taxes, but they also have most of the income, so they should pay most of the taxes. That last chart, you can argue, that I put up is kind of misleading. Rich have higher tax rates, but they also, as we've talked about, have more tax avoidance possibilities. We have the question of how does the tax affect labor productivity? When they raise the tax, let's suppose that we raise the tax from 30% to 70% and made people pay 70%. Would that make workers less likely to work? Does that make people less productive? Does it make you less likely to start a new business? Okay. I claim that John Lennon, the Beatles, if you remember John Lennon, one of the Beatles, was killed by income taxes. And the reason I say that is that in England, England actually elected a socialist government, and they raised, in the 70s, and they raised income tax rates very high. They wanted to do a lot of social things, and they wanted to do it by fleecing the rich. What happened was that the rich left England. So John Lennon and George Harrison moved to New York. Paul McCartney moved to Scotland, which, even though it's part of Great Britain, had much lower taxes, so he just moved to Scotland. J.K. Rowling lives in Scotland for the same reason. There's much lower taxes in Scotland than in England. John Lennon moved to New York to avoid taxes, and of course he gets killed in New York. So if they hadn't raised the taxes in England, John Lennon would still be alive, maybe. But England ended up collecting less money in taxes when they raised the taxes really high because people left. In the United States, we had a 70% tax when England had a 90-something% tax, which means people were willing to move here because it dramatically lowered their taxes. Even though taxes were high here, they were lower than everywhere else. Now that everybody has a lower tax, if we dramatically raised our tax, that would encourage people to try to do things in other countries that have lower taxes. So it's a complicated question. Okay? High marginal tax rates encourage people to try to get out of their taxes, which makes them inefficient. At least we think that makes them inefficient. And we also tax different kinds of income differently. So if you buy a share of stock and you hold on to that stock for a couple years and then you sell it, that's not taxed like regular income. You get a discount on your taxes, for having invested in that stock and held it for a while. And there's all kinds of questions about whether or not we should treat income from different sources in different ways. But we do. So here's the corporate tax rate. The gray line is the average that they're supposed to pay. The green line is the average that they do pay. And again, we have legal tax avoidance, and people figure out ways to not pay their taxes. And so we've been paying a lot less in tax than they're supposed to. And we've just lowered the tax down to 21%, which is close to what they've been paying anyhow. So we'll see. The idea of that was it's supposed to encourage people to put money into the United States, and we'll see if that's what happens. So there's all kinds of issues with taxing corporations. And again, I'm skimming here, and there's lots of readings for you to do and some thinking to be thinking. We tax corporate money twice. When a corporation earns a profit, we tax the profit, and then the corporation can pay that out to its shareholders and we as dividends, and then we tax those dividends as income. So we have double taxation of corporate dividends. There's things that people do, and it's not always there, but heavy taxation in our system in how we tax corporate profits. We always ask the question of taxes distorting economic behavior, and so do the benefits exceed the costs. Apple has about $400 billion stashed outside the United States. And the reason it's stashed outside the United States is they didn't want to pay taxes on it. When we lowered taxes last year, they brought some of that money back into the United States. And the hope was that they would invest that money and build a new factory or build a new something, and there would be income and profits and jobs and things generated by however much of that money they brought back in. Didn't quite work out the way it was intended, but there was for a while an increase in investment. Not a huge increase, but there was an increase in investment. A lot of the money that corporations brought back into the United States that we hoped that they would invest into things that would create jobs, they actually just used to buy their stock back. So there was $1 trillion in stock buybacks last year by corporations. That artificially raises the value of their stock. Doesn't create jobs, it just makes their stock more valuable. Amazon and Starbucks basically pay no income tax. Amazon, in large part because they lost a lot of money in the past, and we let them balance all those past losses against their current profits. And also we have systems where they're, as long as they keep investing in new factories and new warehouses and new stuff, then we let them take that off of their taxes, and so it's you can argue that it's good. Starbucks will talk about how they don't pay any taxes, and it's very fun how they don't pay any taxes. We'll talk about that. So that we were at 35. Trump wanted to lower to 15. We actually settled at 21. That puts us in the middle of tax rates for countries. And remember that on top of their percentage that they've got. So if you look at England, if you find England in there, they're at 19. England also has a 21% VAT. So it's not that England is a low tax country. They're just slightly lower than us now on the profits tax. But we were generally higher than most countries on our profits tax. On the other hand, if we go back to the 50s, we'll see that corporations were paying 30% of all federal revenue, and now last year they paid about 8% of federal revenue. So even though we just gave them a big tax cut, they've been able to avoid paying taxes generally over time. Okay? So where does federal revenue come from? The answer, is in this little graph. So 2017, excise, estate, and other taxes was 8%. So tariffs and federal excise taxes and estate taxes and all that was 8%. Corporate income tax was 9%. Payroll taxes, which are mostly Social Security taxes, are 35%. And income tax was 48%, the personal income tax. We canceled the estate tax. It's going away. So instead of, it was that people had an estate bigger than $1 million had to pay taxes on that estate, the part of it over $1 million. Then nobody's going to have to pay estate taxes anymore. If, again, assuming nothing changes. We cut the personal income tax. We cut the corporate income tax. The personal tax cuts are temporary. They're not permanent. The corporate tax cuts are permanent. The personal income tax cuts gradually go away over the next 8 years unless Congress and the president change that. So far, they've talked about it and tried it a little bit, but it hasn't happened. So consumers starting 2 or 3 years from now will actually be paying, normal people will actually be paying higher taxes, while corporations get a big tax cut unless Congress steps in and does something about that. So we'll talk about specific taxes and specific spending and a lot of specifical stuff as we get to the various sections.